Good morning, everyone, and welcome back to the Schwab YouTube coaching channel for the Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner. Crisp morning here in Denver, Colorado, and I am pleased to be here with all of you. Thanks for joining. Now, today is a solo session for Trader Talk. I am, however, joined by my friend, fellow Schwab coach, Barb Armstrong, in the chat. So please say hey to Barb. She'll get to comments and questions I'm unable to. However, as you know, on a Thursday, when I'm going solo, your questions, your comments are things that I'm going to try and bring into the discussion. So please do not hesitate to post in there for the duration of our show. We, of course, will go about 45 minutes in total to about 10:15 Eastern. Additionally, if you're not already doing so, Barb and I both love to post on X for you. The postings will vary quite widely. I'll tell you what, Barb is one of the most positive people I know, not only a fantastic coach, but just a positive individual. And you're going to get a lot of reinforcement on that view. Just staying positive in your process, learning about the market, continuing our education. Barb is key on reminding us all about that. She's also going to post some good charts for you in there, and I'm going to do the same. You're going to see a ton of chart posts from me if you're following me specifically. So would appreciate a follow there. Make sure you're subscribed to the channel as well, so that you're getting all the updates from us. Let's kick it over to our disclosures, everybody, so that we can dive right in. So please remember that our conversation is exclusively for your information and your education. Remember, we do not make recommendations here. We do not endorse a specific approach to trading the market. We will cover and discuss technical analysis as we review the various areas of the market with you all today. So as I go through the charts, we'll cover and offer up some insights from the technical analysis standpoint that some traders will choose to employ, others will choose to shelve, but it's up to you as to what extent you will use these technical analysis concepts. Some of you will rely on them heavily, some of you will choose not to, but that is your plan. So make sure that you've developed a plan that makes your decision making simple, easy, and repeatable, which is really the key if you are a trader. So, well, one of the keys, I should say. One of the additional ones, of course, is removing our emotions, or at least reducing our emotional tie to our trades, of course. Now, beyond all that, I want to remind you, of course, of our agenda. Here, we do top-down methodology. What that means is we start broadly. We look at our biggest indices. So we'll start out with a brief review on the bigger ones today, the S&P, the Russell 2000, the NASDAQ 100, of course. And then we're going to work through a number of the key sectors as well. But I want to hear which industry groups maybe you're interested in, industry groups perhaps that you've seen on the move. I, of course, am going to give you that look at the sector relationships. We're going to see where our returns have come from on a year-to-date basis, a one-month basis, etc. And then we're going to try and kind of get an understanding of where opportunity may lie. I will also bring into the discussion today some stocks in the news. We have more than a few that have been upgraded today, so we do want to round out the session with a look at those stocks in particular. So with that, let's take a peek at what's going on in the S&P. Now, yesterday, the move that was significant was the bounce back, obviously. So yesterday morning, Rachel and I talked with you all about the importance of getting a hold move, getting a close above the high that we established on our Tuesday session. So Tuesday, to this point, looks like the low day in our very brief pullback to the 50-day moving average here in purple. And yesterday's close happened to be at a level of 68.75 versus the high from the prior day, which was 68.71. So we did, in fact, close above the high of the low day. And today, from that close, what we got was a nice gap upward, not just a gap higher, but a gap through the 20-day moving average, and basically gapped the high of yesterday. So what it appears to be doing is a follow-through day. Now, briefly, I want to remind us of maybe the narrative behind how this occurred. And it's not just specific to the SPX. You'll notice this when we kick into the NDX and the Russell as well. But this price action of weak open, tied directly to the conversation around potential new tariffs that the administration was considering, that got yesterday, mid-session, there was the comment out of the president that said, yeah, we've got the framework of a potential long-term plan or long-term deal relative to Greenland, and therefore no new tariffs will go into effect on February 1st. And boom, the market says, great, we love no new tariffs, and we're right back on track. So always take our narrative conversation with a bit of grain of salt. And then step two, make certain that we are deployed comfortably. Some of us were not comfortable being long when we have a huge candle like we did, a big gap move below the 50-day. And others would have said, yeah, this is just standard practice. So depending on how you choose to approach the market, remember to have this kind of concept, this plan as to how you want to do things. Give yourself an easy way to make your decisions. For a lot of traders, that is simply knowing what you want to do if we get to a point where the market changes or something is different. Right now, one thing that would be different would be more than a single day below that 50-day moving average. So if we're looking for something different, 2 consecutive closes below it, maybe more, would be kind of validating something different occurring or could potentially happen. Right now, more likely looks like continuation. Doesn't mean we have to go to new highs. Let's see if we can continue pushing, but that's kind of where we are right now, at least initially. So we'll see if that's all kind of eliminating some of the admittedly some of the risk that has been built in from the administration. We're gonna, they more or less kind of made a problem and then fixed the same problem, right? So we'll see if that playbook continues to work. Now with the NASDAQ, similar stuff here. Boy, do I have some lines drawn in. Let's eliminate all of those so we can clearly see what's happening here in the NASDAQ 100. So yesterday we talked about, there's been a couple of different things here. Many traders are going to try and draw a diagonal line through the peaks and capture that. But I think what really stands out to me is just how this level right about here has been resistant for us. You'll notice we've had tails into that ledge and each time been beaten back. Now, from a very short-term basis, again, Tuesday, the big gap move lower below the 50-day moving average, a hold at the close yesterday, closing above the high of the low day, and a continuation move today. Nonetheless, nothing matters more, perhaps, than taking out that level right here on a closing basis. We'll call it 25,800. In fact, let's just make it really clean and simple. I'll make it that 25.8 and then 25.8. This way my line is very distinct. Okay, so we know the level we got to get through if we're looking to see a break to new highs. We have to get through that 25,800 ledge on a closing basis to more or less validate it. Now, it's not clear that we can do it, but the quick speed with which we bounce back above the 50, back above the 20, we'll see if it plays out. All right. Yeah, Wiley, I know. We're all still waiting on the cruise. I'll tell you, it sounds like a lovely idea. I'm not certain Schwab's got that in the pocketbooks for us as coaches, much as I would love to love to do that. It sounds fantastic, I got to say. Okay, let's kick over to the small caps. Small caps are up nicely today, almost 1%. You're getting a follow-through day, everyone. So more of the same as it relates to the small caps. Upside again, that's a new high, not just a 52-week high, everybody, on my daily chart here, but that's a new all-time high in the small caps. And what we've been paying attention to, not just the daily chart, but the movement through a very important level that has actually led to continuation. Now, it didn't go straight up from there, as you can see on my longer-term weekly here, everybody. We were into that level, and then we had some volatility and whatnot, but here we are at all-time highs yet again. So, we've been watching that 2450 area a number of times over the last couple of years, working to get through that. And not only did we get through it, we've had an extension through it. So we have been digesting higher yields and going forward with the belief, evidently, that those higher yields may not very well stick, or that the subsequent Fed decisions this year, which are primed right now for 2 cuts between now and the end of the year. And again, when I say that, that is how traders are positioned. That is not a directive from the Fed in any way, shape, or form. But we appear to be digesting this recent move to the upside favorably as it relates to yields. Now, I was of the belief that a move like this, which was big, by the way, big move on Friday, gap move on Tuesday through the 200-day moving average in the 10-year yield here. I was of the belief that this was going to hamper the run that we've seen in the Russell, and it has not. So we have been digesting this favorably. It looks like the bias relative to small caps is to the upside. So try not to fight against what we're seeing. Find and work with proper or moving averages, rather, maybe that the group has been working with. So a couple of key things in here. We got through the level. That's that long-term ledge, right? 2450. And then as I zoom in, for a lot of us, the 20-day could work. But again, that is 130 points away from where we are right now. So not a fantastic move. If you're waiting to the 20-day, right? So a lot of traders, you got to find maybe a faster moving average if you're looking for a reason to take profits on weakness. The 20-day means you're going to be giving up about 5%. Am I right? Let's see. 4.75% from where we are right now down to the 20-day. So you'd have to risk about 5% of profit to be proven wrong if you were going to close or sell some under the 20-day moving average on a closing basis. If you were working with the 10-day, for example, be a lot tighter. It'd be more like giving up about 70 points. That's going to be maybe a little more comfortable for some traders. And you notice we have been above it since the 5th of January. So basically riding our 10-day to the upside here in the small caps. Some traders might look at the 10-day as a means of management. Excellent point there, White Fang. Perhaps the steepening of the yield curve is helping the small caps a little bit. I tend to think that the steepening of the yield curve likely helping out the financials more so than anything. But let's just take a look at the yield curve here, the 10-2 yield curve. I think I got one too many Y's in there, maybe. Let's see. I think I might have it backwards. One more time, and if my... There it is. There we go. So yeah, the yield curve is in fact continuing its steepening. Looking at this on a 2-year basis, everybody, we have been kind of talking about the upward trajectory of the curve, and you'll notice that the yield curve did pop higher there. So yeah, that could have a little bit of an impact. But like I said, I think that might very well be a little more tied to financials, and we'll get to sectors here momentarily. Okay, how about what's going on with the Sox? Had a big bounce back day yesterday off of a very quick flag, and I say speedy or quick flag because you'll notice the drawdown here was all of 2 days. But again, I'm going to leave that 10-day up here because it does appear to be working for the current trend of the semis. Been above it since December 22, and that continues to work. So once more, knowing the level where you're going to make a decision is the most important thing. It's not as imperative that you pick the so-called proper level. The proper level is the one that gives you the most comfort, not the one that everyone else is working with. But it is notable that we've been above the 10-day now for today, what would be 21 bars or just more than 4 weeks. Commonly, we see these potential moves and these holding of the moving averages can last anywhere between 4 and 8 weeks, even longer. The shorter the term on the moving average, the less lengthy the hold can be. But have a plan, have a design, know where you're going to maybe make some new choices, some new decisions. We could certainly continue the upward trajectory of the semiconductors here, and we don't mind it at all from a leadership standpoint. Semis, when they're in gear, very helpful for our U.S. markets, obviously. And then lastly, I'll just highlight the transports. We talked a little bit about this, but again, once more, one of those key factors relative to technical analysis is when we get those consolidative windows like we had right here. Say it with me, everybody. Consolidations often lead, when they break, they lead to trending thereafter. These are the instances that are sometimes difficult for the trader to stick with, right? When we go sideways, we don't get anything done. But notice here that 20-day moving average now basically been held. Once we got outside of the range here, we've basically held it since November 25 or so. That is a fantastic move from a standpoint of maintaining the trend. And we've tested the 20-day now a couple of times, and it has been held. So yesterday, a fantastic hold with a massive candle to the upside. So many a trader is going to tell you that because we moved to brand new highs, you're looking at continuation of the uptrend relative to the transports. And we know the importance of that, because if we're shipping, moving goods across country, that is healthy. Now, admittedly, it doesn't necessarily feel as healthy, but we got to trade what we see rather than how we feel about what's happening maybe locally. Again, I know that from an anecdotal standpoint, when I go to the grocery, everything is pricier. Spending is maybe tightening up a little bit, but we're still seeing transportation groups moving. And if we check the stool legs here, as we are wont to do in this class, we can see which ones are providing us some leadership. So briefly, we've got rails in a little bit of a consolidation window here. We've been back and forth a bit. Our truckers, of course, TRK, there we go. Truckers are showing some strength here. Boy, we built a very pretty clear bull flag here, or maybe more of a pennant than a flag, since that went for about 2.5, 3 weeks there, and then just continued to the upside. So more of the same here in the trucks. And what about our airlines? Quick look at DWC AIR, and we'll see here that we've been consolidating a little bit here. So allowing the recent run to be digested. And look at that 50-day catching up with the horizontal support there. So a little bit of confluence here in the short run in airlines as well. So the transports have been good. Semis have been good. You all know that we've got those Dow theory charts. So here's the first one, our standard Dow theory, right? A 5-year look at the transports versus the industrials. When they are both at highs, it confirms Dow theory. But what about the new, what I like to call the neo Dow theory, which is S&P 500 versus semiconductors? Some traders are going to lean more like this, because the market that we have today differs quite greatly from the market we had in the late 1800s when Charles Dow was developing Dow theory. And some traders believe that a process viewing our leadership group, that being the semiconductors, and the S&P 500, the broadest measure of the U.S. market, can be a way to get a better, more comfortable view of things. And the truth is, both are giving you what we would call to be confirmatory action relative to this so-called theory. So we'll see if that continues to hold. So what about our sectors, everybody? So let's jump into things here. We've had some significant developments in energy and in staples of late. So we yesterday pushed through a level that had been really kind of one we've been beaten back from recently. And I could probably take this high, or this line, excuse me, put it to the highs and extend it here. Let's just do that. We'll go forward a little bit to this current week. There we go. So we've got a new kind of a resistance up there at about 7 at this ledge here, about what is the value of 750 or so, 755. Needing to get through that for some continuation, of course. If we take a peek back at our longer range chart, you'll see that we have been really digesting a substantial snapback following the COVID bottom here. And we have been digesting this for essentially all of the 2022, 23, 24, and 25 calendar years, right? What do we see? You see that whole thing in here, right? That's what all of this is basically consolidation or digestion of this immense move to the upside. And I do mean immense. And remember, we basically took, energy down to nothing. We rallied very quickly over 140 weeks, 139 weeks, rallied 120 plus percent. And then we have then basically spent the next 3.5, 4 years going sideways, digesting it, and now potentially breaking out. So the significance of the potential breakout is, of course, that moving to those new highs gives us an opportunity to flip over the range that we've been in. So if we were to simply kind of validate the range as such, and this again, remember your range here could vary from one trader to the next. Maybe not this low, maybe it's more in the neighborhood of this level in here. These are always going to be approximations. You all know that. So we're just trying to get an idea. But this is one way that some traders would do it. And you just take that line and activate it, add it to the top, and now you've got the potential measured move target on a breakout here in the space. But we know that we can't ever lean into those as guarantees, of course. We never know if they're going to be achieved, but it can give you something to shoot for if you're looking at a potential target. So energy is improving, but let's peek in on oil while we're here. Oil's been beaten back a little bit today, and yet the structure of the shift in the barrel price is what's most notable, I think. The fact that we are above the downtrend line, above both the 20 and 50-day moving averages. It's been about 2 weeks in here, but where are we going to see things developing more? It's going to be on a movement through resistance at about 62 a barrel. Notice the downsloping 200-day moving average in that ledge as well. That's a very important level. We could see a move through this leading to a little continuation or perhaps an additional pop in energy. So we'll keep an eye on that. Now, what about materials? Materials continues the strong move. Yesterday, we had a break of a quick bull flag right here. Yesterday's close was at a new high in the 52 weeks, and I think a new all-time high, as it turns out. And then today we've gone ahead and pushed even a little bit higher. Now, it's too early in the morning to call that a gravestone doji, but that's what it presents as right now, at the top of a run, open high, close lower, but we are only 22 minutes, into the session, so we're not going to call that anything other than an early fade off of a strong open in materials. What about industrials? So industrials holding quite well, utilizing that 20-day moving average. Notice here, everybody, if I just went with the 20, there it is again. Look at how long we've held that. Yeah, we were in consolidation in there. And yet, once we got, right before we broke out, we started to, we're holding that 20-day for a little in here. We busted out, came back and tested, tried to bust out, came back and tested. Then we finally took off. So we've actually been above the 20-day all the way back really to early December here in industrials. So again, looking for leadership groups. One of the thoughts that many of you traders are having is, hey, I need to be shifting to groups that are leading right now. Yes, the semiconductors are pushing, moving to new highs, but so are industrials. Energy's breaking out. Materials continues to move. So don't be consumed by what was a winner for you last year, what were winning spaces for you last year. We have to shift and kind of change our process a little bit with the market as it does the same thing. And so, yesterday, we looked at the Market Watch tab, in particular the quotes page, and we built everything out here utilizing year-to-date detail or 5-day change, 20-day change, etc. But remember to go through your paces. We need to take this time to review the groups of the market that are trending and giving us those opportunities, and then fall back into the top-down methodology. If I'm a believer in, for example, small caps clearly leading today, right, to new all-time highs, perhaps we take a look at small cap stocks broadly, and then over the last month that are maybe energy specific, right? 20-day window, energy leading the charge up 9.6%. On a 20-day period, the relative strength means it's also outperforming the overall broad market here at a 91 clip. So energy has been providing that. And so some traders might just simply look and scour the market or scan for small cap stocks in energy sector specifically. That's just one way to think about it. It's not the only way, obviously. There's a lot of ways to go about your process, but make sure that you aren't sticking with one group. That is to say, don't stick with the group that you know has worked for you recently, unless it's still working. Like if you're struggling and not understanding why, it might just be because we're trading the same things that aren't moving the way they once did. I'm glad you asked that, Disorderly House. Let me show it to you here. You're asking about specifically these percent changes over year to date, 5-day, 20-day, and 6 months. Recently, those were added columns for us. So we can get here to the gear icon in the upper right corner there, hit customize, and then you'll notice right off the top, percent change since. So I loaded 4 of them. Once loaded, they default in here to 5-day. You just click the time frame and select a different one. Great way to go about this, obviously. You don't have to use them all. You can use just the one you want. But this is a good way to kind of keep a close eye on the sectors. Of course, I'm using just the sectors here, but you can also choose to utilize some of those public groups like the sector. Let's see here. There we go. Sectors and industries. This would include all the industry groups and sub-industry groups within the 11 sectors as well. Now, that does mean, commonly, at least in my experience, that you're going to maybe see these columns take a moment to load, like we are getting here with some of these relative strength calculations. But it is a substantial list if you wanted to incorporate the industry groups as well. Okay, let's keep on moving down the ledge here. Back to my charts. All right, so we talked energy, we talked materials, we talked industrials. What about the discretionary group? I'm gonna put my standard charts back up. So we're kind of in meander mode here. Notice we still above this basically everything that's going on in here. Is kind of telling us that we've got an uptrend still, but you notice that we made a high 2 weeks back. And now we've been kind of breathing. So discretionary, not quite as strong as once was, but still in trend to the upside, it would appear. Nothing significant in development at this moment. Let's keep on going. Now, the staples, we have seen a significant development because we made this incredible move from 850 up to 915, building what looks like a pretty substantial flagpole, and then our flag itself kind of in a stiff wind because, as you'll notice, we've given a little bit back. We've had a little bit of volatility, but there's still an upward trajectory to that flag. And so some would call that exactly that, a flag in a stiff wind with a little bit more upside, perhaps. We've been up to that ledge around 919 on this space. We've not been able to pop through it. So, remember our resistance and support lines. These are all eye of the beholder type things, but if we can pop through and make a new high here, that would be significant on the staples. Some might even just say, we need to push that line higher, Kev, so we can always just push it up if we prefer. But once more, from a longer range standpoint, what are we seeing? A pretty healthy range here, 830 to call it 930, 100 points. You know what? That means if we got through 930, some traders would assign another 100 points to the upside, just as an estimation of how high this could rally. And of course, the narrative aspect of staples providing leadership is less ideal. It might mean that we aren't going to see the level of returns we've had from the S&P 500 over the last few years, as you know, remembering back to 23 being a really good year, 25%, I think, 24, something similar, 25%, and then last year more like 17 in the S&P. But again, that was during windows where technology was really providing that leadership. And if technology is not providing that leadership, our returns can be buoyed by staples and energy and healthcare, perhaps, but we're not absolutely likely to get the level of return that we have been seeing over the last 3+ years or so. So we just need to bear that in mind, I think. So staples are dabbling with a potential breakout. And then healthcare providing some leadership as well. Yesterday broke the downtrend line on the close. Also had that hold move on a beautiful candle day. I mean, this is about as clear a hold. We got it real early in the day and held it throughout. So potential for what could be continuation after holding horizontal support in here, making matching lows, not lower lows in healthcare. And then on to financials, which have in fact been pulling back over the last 2+ weeks. We are below the 50-day moving average in here. Could we have tested support with that low? Perhaps. But if we're looking at the trend traders are going to want to get back above the 50-day and this 900 level approximately, so that we could validate getting back in gear. Right now it looks a little stalled, so keep an eye on it from a financial standpoint. Moving on down the line here, here's our tech. This is the one that bears the most watching, because even though that level of green line has been held here, everyone, the concern is the fact that we still have lower highs to matching or horizontal support. So this horizontal support can absolutely maintain for us. I'm going to draw my line out, just give this a little, just so I can capture the historical level here. So you can see the importance of this ledge. So the fact that we bounced off of this ledge a little bit, or at least stopped the selling at this level, that's the first thing that must happen, of course. This is not great, but it's also not as of yet terrible. We haven't violated horizontal support. We could suggest that we've not made a lower low, just matching lows. And you've certainly heard me say that matching lows are fine, lower lows not so fine. Well, we do have lower highs, so the fact that we've not made lower lows means we're probably going to break just one way or the other. We just don't know which way. So if you're waiting for tech, if you're trying to validate being in technology, a lot of traders are going to wait and see, can we get a close over the downtrend line, which would be a significant development because of where it resides, right at the confluence of the 50 and the 20-day moving averages. So why is confluence important? Well, the more we have traders utilizing either time frames like this one, where we'd say trader in a 20-day window and a 50-day window is evaluating resistance at the same level. That means that we've got multiple traders, multiple time frames, thinking about a price range acting as resistance or support. Resistance in this case. So moving through that level would be a significant development. We would love to see, if we are bullish, we would love to see a close above both the 50 and the 20 and the downtrend line. That would give some belief that we can get the technology space back in gear. All right. Let's see. What about communications real quick, which is having a really great day. In fact, giving us some leadership today, up 1.2%. Still in a little bit of a range after having broken out in here. The fact that we again have held the range kind of stands out for some traders. So we could kind of draw it like this and say, hey, we need to get outside of the range, and that'll help us out. We'll understand more there, but really just in consolidation for a little bit, I think, everyone. And then let's wrap it up with a quick look at our utilities today. Utilities pulling back from the 50-day. We did have that bullish divergence with our new low in here in the short run. We made a higher low in the RSI there, everyone. But as you can see, we got rejected at the 50-day moving average. I think this is one of those wonderful scenarios where, I say wonderful, where it just allows us to speak about the need for rules. This here, one close above the 50-day for many traders, not a sufficient amount of closes to validate a breakout. And as you can see, we quickly are back beneath it, right? And this, now we're trading at the lowest we've traded in the last week plus. So for many, this would look like already a short-term rejection at the 50-day moving average, kind of validating once more the importance of needing to be above the 50-day. You could also choose to maybe draw in a downtrend line through here as well. And we could say that we got rejected at the confluence of the 50-day and the downtrend line also. So if nothing else, we might know some areas above which this pattern, this trend can shift in utilities. So that bears watching, as does the real estate. Remember here that we're talking about the actual, like the REITs, right? This is not commercial real estate necessarily. This is going to be more specifically tied to the real estate investment trusts. So dividend paying or interest bearing investment vehicles have not gotten outside of this range for some time. This takes us back into basically May of last year, April, May of last year for the range. So you're looking at what is about 9 months or so in length of consolidation in here. So that would be significant if we can get a shift on that. And then the last one I'm going to touch on here is going to be the home builders. I'm going to use my Dow Jones Home Builders symbol here, DWCHOM. We've been keeping a close eye on this. We have broken that downtrend line. We have also failed at what has been resistance for us in here. Try to get through this. This would be good. But the fact that we've held the downtrend after the breakout is not terrible. In fact, yesterday's candle closing above this day's high could mean there are more upside opportunities in the space, or perhaps in this collective industry group here based on this move. But from a trend standpoint, you want to get through this. I'm going to color that red for y'all. Get through that red line, and now we start having some opportunity. So potential for opportunity, I should say. Now, there's your sector look at everything, everybody. Obviously, sector relationships, very important. Talked about the use of the Market Watch tab, looking at those quotes, getting an understanding of where we are looking for potential opportunities and which groups are maybe under a little bit of pressure. It's pretty clear that our Mag 7 are not really providing the leadership that they had been. So it doesn't mean you can't look to them, but it does mean that if you're looking from a trend standpoint and a strength of trend standpoint, our leadership is not currently in technology. That's it. All right, let's get to some upgraded stocks in the news today in our final few moments, upgrades and downgrades. So let's talk about a couple of familiar names. I just got done talking about the Mag 7. Well, one of them that's actually been showing a nice uptrend is Alphabet. I'm going to back this off to a 1-year chart, and I'm just going to, wow, look at the uptrend there. The 20-day has been a little bit, porous, as we might say. We've been through the 20 a number of times, but the 50-day has not been violated for quite a while. You got to go back to May of last year to see that. So we've been running this one pretty strong against the 50-day. Now today, Google or Alphabet was updated, upgraded at Raymond James, upgraded to strong buy from outperform. A new target is at 400, up from 315. Again, that's just the analyst comment. That is not a guarantee in any way to be achieved. They state that the firm's updated bottom-up analysis of the Google Cloud platform and search drives a material upward revision for their 2026 and 2027 estimates, with 2027 revenue now at the high end of the street, and it supports their upgrade. So they continue to like Alphabet here in the longer run. Another upgrade today is in Datadog, although you're going to find this chart to be a bit different, everybody. So here you have an upgrade following a bit of a pullback. Stock had done very well, pushing off of lows from Liberation Day all the way to the peak achieved here in mid-November. It was up 140%, 145% even. And since, all we've done is bring it back. We went peak to trough here, dropped about 40%, 42, goodness. So, if nothing else, you could say, well, at least the analyst is giving you an opportunity for entrance at a better level. But from a trend standpoint, we haven't fixed the downtrend yet. We are at the 20-day. Traders would love to see this get above the 200 at least to kind of get you back into gear, perhaps. The analyst that upgraded here was Stifel. They did so to buy from hold, new target of 160, but heads up, that's a reduction. This was a new target, or prior target was 205. Now, it would represent a 30-point premium if it got to 160, but that still tells us that there is a shift in what was expected out of this company previously. So if nothing else, Stiefel waited until a 40% drawdown before coming back in and giving an upgrade to buy, but the adjustment on the price per share does stand out, moving downward from 205 down to 160. So wanted to make sure talked about that one. Additionally, we have Texas Instruments got an upgrade, TXN. Now, here they got upgraded at BNP Paribas. They were upgraded to neutral. Previously had been at underperform, and BNP put a target on them at 190, citing the industrial restocking that is underway, stating that the company should benefit from a couple of quarters of the restocking. Now, the move here is a little interesting because from a trend standpoint, there was a pretty good level that it needed to get through here, and it has over the last month done that. And now you've seen it continue to push higher. But depending on how you choose to look at this, this is one of those where I would say, as a trader, many of you who are here frequently, you've heard me say that sometimes it's as simple as kind of defining the window of time it took me to look at the chart. And if I immediately know what's going on, well, then I might have something to work with. Conversely, when I look at this, could I draw more lines? Could I develop a pattern? Could I find opportunity? Sure. But the chart is a little less clear. You know, one thing that stands out, we had this brief pullback after testing the 200-day, then we moved higher. You got a very quick hold of this level, and then we moved higher. This is just not as clean a new trend as many traders are looking for. That said, certainly doesn't mean it can't go upward, but just not as clean. Remember, the target on this one is at 190, and we're already trading above that level. Something else to keep in mind. All right, one more upgraded today that I thought we could hit on was Rigetti. B. Riley analysts upgrading Rigetti to buy from neutral, and they put a target on Rigetti, RGTI that is, at 35. Now, that's substantial just based on the fact they believe it can get there. We don't know if it's going to get there, but that's a pretty healthy premium. You're looking at about, what would that be? About 40% from where we are right here. So if we, from 24.5 up to 35, 10 points, yeah, that would be pretty substantial. And if it got there, of course, we know it doesn't have to get there, but that's what they're suggesting. So I wanted to look at this one, not because of how it appears on the daily, everyone, because you can see we are in a little bit of a price figure mode. We're trying to find if price can maintain these levels. I could draw the line here, but what's the point, right? I mean, I've got the 200-day right beneath us. And a lot of traders are going to lean into that, regardless of what you've had over here since, really since mid-November. It's really just going sideways, right? So if that's the case, for a lot of traders, they would only choose to move on if we busted the 200-day moving average on a close to the downside. You'll notice we've been above the 200-day. Let's go to a 2-year. My goodness, we've been above the 200-day all the way back to November of 24. So you're looking at about 15 total months, right? All of 25 in the last month of 24, first month of 26. So it's been moving, but this throwback seems kind of notable, and it's an important level. But the way to look at this might not be the daily, but always take a peek on your longer range stuff, everybody. Let's take a look at my weekly chart symbols or my moving averages. So there we go. I've got a 20-week and a 40-week and a 100-week. The 40-week seems pretty important here. So from a trend management standpoint, maybe under the 40-week, things get decidedly different, but that's going to be very close to the 200-day simple moving average on the chart. And there's that line. I just drew it in. It's like pretty much right on it, right? That's pretty intriguing. So some traders might choose to manage risk there. Unfortunate that managing risk that way right now means you're doing so giving up about 3.5 to 4 points to the downside. That's a little bit tricky, not to say the worst by any means, but I know from a risk reward standpoint, something to keep in mind. Okay, last thing I'm going to mention, everybody, is that while I'm in the process of wrapping it up, One of the things that we've been doing in this class is just reminding you of all the features and functions, and that's of course important, but equally important is that you have a way to connect and meet up with us coaches. So don't forget that you can follow us on X, Kevin Horner, CS, Barb Armstrong, CS. We would absolutely love to hear from you there. And then additionally, we recently debuted the new coaching page where you have an opportunity to meet the coaches or basically learn a little bit about us individually. This is under the Learn tab here or schwab.com/coaching. So this is the same page that you can come to for our calendar of events, our live and in-person events as well. But if you wanted to meet us coaches, come here, check out our individual breakdowns. You can learn a little bit about us, find out which of the coaches you may connect with most. I really encourage you to do this because, trading is a community, and listening and learning from the people with whom you connect greatest can be an excellent way to solidify learning. So keep all that in mind as well. So with that, we'll wrap it up for the day. I want to thank you for joining and participating. Always a big thanks to Barb for managing the chat. Make sure you follow us on X. Hit that thumbs up button for me down below if you like the review we offer up here on a Thursday morning. And beyond that, make sure you're subscribed to the channel. Always appreciate seeing you. Thanks for being here. And I look forward to catching up with you all again real soon.